Okay, good morning and good afternoon and good evening. Welcome to today's webinar, Creating Social Impact from Financial Decisions. I am In Woo Jung, manager of the Green Finance Platform at the Green Growth Knowledge Partnership. The partnership is a global partnership of over 90 organizations dedicated to green growth across the policy, industry, and finance communities. And serving the finance community, the Green Finance Platform provides curated database of research, regulations, tools, and guidance for banks, investors, insurers, regulators, and standard setters to enable sustainable finance practices aligned with international standards. This year, the Green Finance Platform launched a series of webinars titled Finance Meets to support the increasing momentum to integrate ESG and sustainability factors in financial decision-making. The first webinar took place in March in celebration of Women's History Month, looking at the intersection of finance and gender. The second webinar was held in May, exploring ESG accounting and disclosure trends and their implications for the finance sector. And today, we invite distinguished experts in the fields of social and sustainable finance to discuss how to integrate social impact into financial decision-making. Before we get started, I'd like to take a brief moment to draw our participants' attention to a few ways in which you can participate today. Throughout the discussion today, we welcome your comments and introductions in the chat box. If you would like to pose any questions to our panelists, do make use of our chat and Q&A box. It's a great opportunity to engage directly with the panel of experts we have today. After the webinar, we'd appreciate it if you could take 2 minutes to complete our short survey. Your feedback will help us improve our future webinars. Please note that a full recording of the webinar will be available on our website within 24 hours of the event. You can also stay in the loop about future GGKP webinars by signing up for our newsletter at ggkp.org/subscribe. I'd like to also direct you to thegreenforum.org, an online community space for sharing and discussing insights on a range of themes and issues related to green economic transformation. Please share your insights on discussions around sustainable finance and other topics on sustainable development. Now, it is my honor to present today's panelists. I would like to invite our panelists to turn on their videos. First, we have Joanna Pedro, Social Lead at UNEP Finance Initiative or UNEP FI. Joanna leads the Social and Human Rights team at UNEP FI. And prior to joining UNEP FI, she worked for over 15 years as a social and environmental specialist for major engineering projects. We also have Ekaterina Chugarova, Technical Officer at the Social Finance Unit, International Labor Organization. Ekaterina is a sustainable finance and just transition specialist at ILO. Ekaterina has a background in financial services and experience in asset management and sustainable investing at ABN AMRO and is a CFA charter holder. Lastly, we have Eric Cristianto, Director, Sustainable Product Specialist at the APEC office of S&P Global Ratings. Eric is a director at S&P Global Ratings, focusing on sustainability solutions. Prior to his role at S&P Global Ratings, Eric was responsible for the business development of True Cost, ESG Analytics Division of S&P Global. And he was also a consultant at the pioneering climate change and sustainability team of EY Singapore. So thank you to all those panelists for joining us today. And without further ado, I would like to jump right into our panelists. First, I would like to ask Joanna, can you please give me a brief overview of UNEP FI and your work on the social side of finance? Thank you.
Sure. Thank you so much, In-Woo, and thank you so much for the invitation. It's great to be here and speak with all of you and to share this panel with my colleagues. So thank you so much for that. So as you just mentioned, I'm working with UNEP FI, and UNEP FI is basically a connection between financial institutions and the United Nations in order to promote sustainable finance. So we work across different thematics, and of course we feel that social and human rights is something that underpins financial sustainability. So the team that I'm leading is looking exactly on how to promote social and human rights within sustainability. We are focusing 4 different areas. One of them that is really important for us is the financial health and inclusion. We just published a report coming out of a commitment we have with several banks on how to measure financial health and inclusion and the real impact that that has in the economies and on the people. We just published a report where it draws the attention to the different targets that were set by different institutions, and we're really looking forward now to see in the next years how those targets will look like in terms of the results. So at the moment it was about setting the targets, and we are now wanting to see the impact that it actually has, the direct impacts that it has. So we're looking forward for that. We're also working quite a lot in gender equality and how to support banks, particularly in defining their frameworks on gender equality, both looking inwards, so within the banks, within their own workforce, how to strive for gender equality, but of course then in terms of their portfolios, how we can look into the financial health and inclusion of women and women-owned business, and then also how can we look at the portfolios and see how these portfolios can contribute to projects that we know that support women's empowerment and equality, but also how can we ensure that the portfolios do not lead to, do not exacerbate inequalities that already exist. So on that, we actually launched this year framework together with UN Women on how to be a gender responsive bank. And we want to work with our members looking, moving forward on that, and on also publishing the results of that work in terms again of impacts. Then we also, of course, as I mentioned, we think that human rights is underpinning the sustainable finance. So we launched this year a human rights community of practice. We have at the moment around 40 members on it from all the regions. And it's really about a peer learning community. So where we share the challenges and the experience of different financial institutions around human rights. And we're also putting together a resource center for banks on how to align with UNGPs, so the UN Principles for Business and Human Rights, which we believe is a framework that really supports businesses and particular financial institutions on understanding what is their role when it comes to human rights. And finally, one of the most, I think, relevant things when it comes from social is the interactions. How does social interact with environment? How does social interact with climate? When we speak about biodiversity, we need to speak about indigenous people that actually are the guardians of most of the biodiversity that we have. When we speak about climate, we need to speak about the people and the communities and workers that need to be part of the transition. So on that, and I'm very happy to be sharing the conference also with Katrina from ILO. So we are working together with ILO at the moment on a guidance on just transition for both banks and insurances. And we're really trying to see on how to connect these different areas and how to ensure that we are not trying to move in one area of sustainability without moving with the others. So we're really trying to see how we can move together with the different areas of sustainability. I think that's a summary of what we are doing, but very happy. I will put in the chat also just our website and specific website of social and human rights team, and very happy to continue any discussions following this conference.
Thank you so much, Joanna, for that introduction, and I'm sure we'll hear more about the work of social work of UNFFI in this webinar. Now I would like to turn to Ekaterina from ILO. Can you please give me a brief overview of ILO Social Finance Unit and your work on the social side of finance? Thank you very much.
Yes, hello everyone, and thanks as well for inviting me to participate in this webinar. So my name is Ekaterina Chibarova. I work for the International Labour Organization, and perhaps we want to take one step back and just highlight what the International Labour Organization is. for those who might not be aware of it. It is a specialized UN agency, and its mandate is to promote decent work. Decent work is part of one of SDGs, SDG 8, but at the same time, it has an overarching influence on many other SDGs. Another thing to note also is, as a specialized agency, ILO has quite a particular governance structure. It reunites governments, workers, and employers organizations who work together around the topics of labor rights and employment implications. And the main functions of the organization as such is to convene these actors who reunite together and set standards. In our case, these are the labor standards. And the idea is that everyone agrees that these standards are relevant, that they're applicable and and implementable. And then the organization supports their dissemination, working both with governments at different levels, but also non-government entities, including the financial sector. The financial sector is perceived as one of the key actors, which is enabling the transition to sustainability. And that is why we are also actively collaborating with the sector through the ILO Social Finance Program. The program is run at the ILO for the past 30 years, and it works with different actors from governments, regulators, and individual institutions in banking, investing, and insurance industries on topics of sustainable finance, sustainable investing, financial inclusion, and trying to integrate decent work in practices and regulations which cover this sector. One of the topics I'm particularly working on, and that Joanna has already alluded to, is the topic of financing a just transition. So we're trying to figure out how the financial institutions, through their practices, through their day-to-day operations, can contribute not only to the climate transition, but to a just climate transition. We started this work a couple of years ago by doing research, surveys, and awareness-raising campaigns, actually. And now we move to the next phase, which is developing guidance for financial institutions. Last year, we teamed up with LSE Grantham Research Institute and developed the Just Transition Finance tools for banks and investors. You can perhaps have a look at this document, which is an open source one and is accessible from the ILO side. It can give already some background information on what Just Transition is and what actions these actors can take to support it. And this year, as mentioned by Joanna, we are expanding this guidance. We are trying to include insurance activities within and provide some more tangible examples. And we will be launching the report that we are working on at COP28 at Just Transition Pavilion in Dubai.
Great. Thank you, Ekaterina. It's very nice to hear that we have active partnerships forming across not just international organizations, but with the private sector, the very actors in the finance transition for this purpose. Now, we'd like to hear from Eric. Eric, can you please give us a brief overview of S&P Global Ratings and your work on the social side of finance? Thank you very much.
Thank you, Inwu, and good morning and good afternoon, everyone. It's my pleasure to be here. First of all, I would like to introduce my company. S&P Global is one of the world's leading providers of credit ratings, benchmark analytics, and workflow solutions for global capital markets. I work for the ratings division, where we support our clients with their financing needs. We provide them with credit ratings, as well as second-party opinions for ESG-labeled financing instruments, such as social bonds and social loans. Now, in the context of today's topic, I would like to focus on social bonds and loans, as well as sustainability-linked bonds and loans. And what are these instruments? So allow me to just give a quick introduction. So a social bond or a loan is a debt instrument that an issuer could raise for the purposes of investing in assets or projects that would derive a positive social outcome, or that could mitigate a specific social impact. Now, examples of these types of assets or projects are investments in affordable housing, investments in projects that give access to education, access to healthcare, improvements in food security, to just name a few. Now, what about sustainability-linked bonds or loans? Sustainability-linked financing is a debt instrument that encourages the issuer to contribute to sustainability impact. So this financial instrument incentivizes the issuer to meet a certain key performance indicators by offering interest rate discounts or perhaps providing a stick as well. For example, paying a higher coupon rate if they fail to achieve the target set by themselves and their capital providers. Some of this KPI could be social linked as well. For example, the number of employment created for different gender, different age group, etc. That's why I think it's important for me to talk about this instrument. Now, what does S&P Global Ratings do in this field? We review these instruments and we evaluate whether the projects that they have identified fit for purpose to be called social bonds or social loans. We evaluate the key performance indicators and the targets that the issuers have set to see whether they are credible and whether they are robust. And this review is important so that we make sure any investments that are made are according to what has been advertised by the issuer. Now, I also want to spend maybe 2 minutes to talk about a recent research that my team just published last week. And I'm sharing my screen right now to just show you some data that we have published last week. So the GSSB market, or the green, social, and sustainability market, are forecast to increase by 5 to 17% this year. And this is a significant number because we are going to break the $1 trillion mark in terms of types of financing instrument. And if you look at chart number 1, this first chart, our view here is that issuance growth will be significant all across the board. Although if you look at social issuance, the social bonds, it will grow the slowest in 2023. Now, this is because the tremendous growth has happened in 2020 and 2021, largely driven by local and national governments when they are issuing pandemic relief programs. Now, despite the contraction of the social issuances, we can see that in Asia Pacific, again, go to the next slide here. In Asia Pacific, the proportion of the social bond is much higher. For the same period, globally, we're looking at about 18% of the GSSB market that is formed by the social bonds. In Asia Pacific, we are looking at 26% of them. Now, we observe more interest from public finance entities seeking social bonds. This year, really the focus is to finance more of affordable housing projects because of the rise in interest rate and because the housing stock has struggled to keep up with the pace of demand. Now, the other types of projects that we see are coming in strongly is the access to affordable finance. This has become increasingly difficult for many individuals because of the current economic environment. Now, financial institutions, including banks and the non-banks lender, are exploring ways to secure financing to support lending to underserved segments. And this has been a key driver that you can see in Asia Pacific, which is why the growth in social bonds has been higher. Now, S&P Global Ratings in the past 2 months alone, in July and August, we have supported the issuance of more than $100 million of social-related financing, happen to be all in for the affordable housing. But based on our observation, we will start to see more and more types of social-related projects and financing to come into the picture. So this is just some of the summary of the research that we put out. If anyone is interested in it, I can share the link either through Inwu, or you can go to our website and find the research report. It's available to the public. And I'll stop here, Inwu, and pass it back to you and see if there's any questions. Thank you.
Thank you, Eric. It's very nice to hear from the standard setter and ratings provider point of view, because I would say you would have literally first-hand data on all of these social bond and other sustainability linked instruments. And it's very encouraging to see that we have some strong growth coming from these areas as well. Now I would like to move to our next set of questions. Again, maybe we'll also start with Joanna as well. Joanna, what are key considerations? What are key social considerations for financial decisions, and how would we measure and report on social impact?
Thank you, Inu. So I'm it's always difficult to be the first, but I think there's a lot to unpack within this question. And maybe I think actually, especially from the presentation also that Eric just gave, I think maybe from the social impact more side, he might have some more insights, interesting insights to give. So I think on the social considerations, maybe I'll now look more into the risk side of it. Because I think when we speak about social, we do need to have these two ways of looking, right? So we, on one hand, more the impact and opportunities, but then we also have the risk and this notion of not only looking at our portfolios and not only looking at the decisions that we are taking based on the risk to the business, but also the risk that that can pose to the environment and to people and communities. So that part, I'm taking the opportunity to already kind of answer somehow one of the questions on the Q&A, to say that one of the frameworks that can support on this making decision, we believe is the, as I mentioned before, the UNGPs, the UN Principles for Business and Human Rights, would give us a framework to support on human rights due diligence, which does not necessarily mean that we need to have different systems and different things in place separate from our environmental and social due diligence, but that we need to integrate human rights within our environmental and social due diligence to support us in our decision. So to check the risks for communities, to check the risks for right holders when we are making our decisions. And I think it's important to also think, because often we think, but this is then not good for business. And I think there is financial institutions are not away from the communities where they are living. So if we are having social disruptions, if we are having, as we're having now, the inflations, this all then has also a direct impact on financial institutions. So looking at these risks to communities, it's also a way, of course, on looking at the risks for the business in the long run. So I think this is also important to have this notion, and therefore I think it's very relevant. And there is, again, the UNGPs does give a framework also on what to disclose. So the moment we are disclosing the processes that we are doing in terms of due diligence, and we are disclosing which mechanisms there is also then for people to request for when they are being impacted by projects and by finance products, then we are giving also this opportunity for grievance mechanisms to appear. So I think I would now focus more on the risk, because I know that we don't have so much time, and I would give then the part of the of impact to my colleagues.
Great, thank you, Joanna, for focusing on the risks and for your valuable insight. Now, Ekaterina, could you answer the same question, please? What would be key social considerations in financial decisions, and how do you measure and report on social impact?
Yes, sure. Let me try by starting by message that maybe it's difficult to identify key issues which would be applicable for everyone, right? There is a lot of different social considerations, and they play out very differently in different regions, in different sectors. And perhaps a good starting point is by just understanding on these general dynamics and the implications that they can have on different industries, on different enterprises, and for financial institutions themselves. I would also like to echo a couple of points mentioned by Joanna. One side, it is very important to focus on risks, but also not to forget the opportunity sides, in particular for financial institutions who can have additional levers and can actually use this social lens maybe to identify business or investment opportunities, responding to some social deficit, to some social needs in the areas where they operate. And secondly, that there's a need to adopt a double materiality approach. So not only looking at what is impacts for the business and consequence by to financial institutions, but also looking at where their activities can generate bigger impacts, be it human rights or what other type of impacts. I think that the topic of just transition, of financing a just transition that we are working on, gives a very good lens actually to start approaching this work. We know that in the end, the low carbon transition will generate a net positive outcomes. For instance, in terms of employment, the ILO research shows it. But at the same time, we know that some industries will be very heavily affected by job losses, by losses of income, and this needs to be carefully managed. It is also not necessarily safe to assume that green activities will be able to absorb all the workforce, which will be made redundant in high-emitting activities, and that we know that there are some temporal, some skills, and some geographical mismatches in these activities. And all this needs to be addressed. And I guess this is very relevant for financial institutions which invest in businesses, and these dynamics directly affect business operations, right? Maybe to name a few, but that's definitely not an exhaustive list of social considerations to take into account, would be, in addition to human rights, respect of labor rights, all these employment impacts that I just mentioned in my previous message. The skills mismatch and the need for skills to promote the transition to sustainable activities and make the economy running in this new mode, and more general the inclusivity of the process, be it financial inclusion, but also including underrepresented groups in the decision-making process. Yes, it's also crucial to be able to measure, in particular financial institutions who are very much driven by data, and it's way easier to take decisions when you have a quantifiable indicator and you can compare your options between different investment opportunities, let's say. And therefore, it's also crucial to be able to quantify social risks, opportunities, and impacts. From the ILO perspective, I wanted to highlight a piece of work that my colleagues did a couple of years ago with the Global Impact Investing Network on developing quality job investment strategies and accompanying indicators, helping investors, impact investors, to see how can they achieve this impact and measure this impact as well. They identified 5 different investment themes which promote quality jobs creation, and also showed a couple of entry points how actually investors can promote them. It can be through investor practices themselves, so the activities that these companies are doing, but also through thematic investing, so basically identifying companies or industries which respond to the local needs. And I believe it is very relevant to include this angle to financial institutions' activities.
Thank you, Ekaterina. It's very insightful to hear from the just transitions point of view as well. And I think we should, as you say, always recognize that we cannot just assume that we have the complete knowledge, as this is a very quickly evolving area, not just for finance, but all sectors as well. Now, I would like to ask Eric about the same question. Eric, what do you think are some key considerations in financial decisions, and how do we measure and report on social impact?
Yeah, so within S&P, we think about this through 2 ways. So maybe let me break down the question into 2 parts. And the first part on how do we look at social factors in financial markets or financial instruments. Within our credit ratings space, for example, today when we look at and evaluate credit rating, which effectively talks about the likelihood of certain issuer to repay their debt, that's what a credit rating does. We actually look at the ESG and G components of it, and social factors feature very prominently in our assessment. If you look at some of our publications, we used to publish a monthly report about what are the key drivers of the increase or decrease in credit ratings. Social factors often occur in certain months as the key driver of the changes to that credit rating. So when we look at those factors, a couple of things, key themes, key social factors came up quite strongly. So workforce and diversity and how it impacts your credit rating, health and safety, indicators. It's very important, as well as the communities and how the company is engaging with the community. And I think there has been a lot of examples that we've seen out there on how when certain companies are not paying attention to how they are treating their workers, for example, and how it immediately causes a negative impact to their own operation, and therefore, eventually the P&L of the business, because when it disrupts your operation, you cannot produce, you cannot distribute your product, etc., etc. I don't think that part is very clear cut. So it's very important for a company to pay attention to the social impact that they have through their own operations, through their own supply chain. Now, on the second part, how do we measure and report on the social impact? Now, this is not something that we do directly within S&P Global Ratings, but through our work on providing the second-party opinion, we observe and evaluate this component very frequently. If I use the social bonds example, both actually, social bond and sustainability linked bonds as an example. When somebody is structuring those financing instruments, they have to report on their impact, ideally on an annual basis. Now, that is important because it's a way for the issuer to showcase that we are actually engaging in a real project with immediate impact, and they have to report that impact. And how do they do that? When I read their reports, often they reference, especially for social-related projects or social-related KPIs, they often reference the Sustainable Development Goals as the eventual goal that they want to report to. Now, for example, if they want to reduce poverty, they have to be able to identify, first of all, what is the output that they should track to eventually tie it to that impact of reducing poverty. So one of the indicators could be reporting the number of good quality jobs that they are providing to the community. And what does good quality jobs mean? Maybe a job that is paying more than a minimum pay in a country, or whatever definition that the companies so decide to choose, right? And a good company would usually identify and define those output very well. They would report how they intend to measure those output and commit to track it to showcase the eventual impact on whether they reduce poverty in the community, in the village, where they operate in. So that is some of the examples that we've observed that issuers have done in the market. And I think we have started to see more and more issuers adopting really good practices in tracking the output and then making that connection to the eventual impact, be it reducing poverty, creating a better houses, more affordable houses, access to financing, et cetera, et cetera. So I think the SDG metrics could be a very good reference for people who are interested to start measuring or determining what KPI and output that they want to measure.
Great, thank you, Eric. And yes, as especially for financial instruments, these indicators and KPIs, I think they are both the number of these indicators as well as the effectiveness. I think that's also something that we try to always improve in these private public partnerships. Thank you. And now I would like to move on to the next question, which is about enabling environments. And this time, maybe I'll go in the reverse order. Eric, how do you think we can create enabling environments for financial institutions to integrate social considerations into their practices?
Yeah, so for this part, I think it's very important for the financial institutions themselves to understand that they as a business have an impact to the community that they operate in. And for this, actually, I want to share another piece of the research that we did. And it happened to be specific to Korea here. So within Southeast Asia, South Korea is actually the second largest market for GSSB issuance and the #1 market for the social bond issuances. If you see here the yellow color in 2022, this represents the social bond issuances in Korea. And it's significant. It's not often that you see a market where social bond issuance is the biggest component of their GSSB market, but South Korea is. Now, why is it like that? And let me give you an example from a couple of issuers that have published their social bond and the reasons why they publish it. So the corporates and institutions in South Korea are very enthusiastic about social bonds because they recognize the demand in social bonds are quite strong, and they see this instrument as an effective way to raise capital, but also create meaningful social impact. Now, one of the example recently issue a social bond, Shinhan Bank. They issued about $500 million gender equality social bond, targeting women, so provide access to capital for women because about 3 million SMEs in South Korea are actually owned and operated by women, and they want to make sure that they have access to this capacity so that they continue to be involved and have meaningful effort in the economy. So that is one example. And the other example from a financial institution, again in South Korea, is KEB Hana Bank that issued about 600 million euro of SME empowerment social bond, again targeting the SMEs. Why are the two issuances targeting this group? We may know that South Korea is best known for its conglomerates, but local SMEs are actually a vital part of the economy. 99% of the country's companies are actually classified as an SME. They generate about 82% of the employment and contribute about 48% of exports. So it's a very big part of the economy that to many people, they may not realize the importance of it. But these financial institutions, through understanding their book of business, know that this is a group where they need to be able to provide that financing. So understanding your target market, your audience very well is key here. And they realize that they have the ability to issue the social bonds and drive impact at the same time. This is why, I would say, back to my first point, the commitment from the top, the CEOs, the C-level, knowing your customers very well, and what are the problems that they're facing. And that can really drive financial institutions to look at this financing instrument as a really good way to derive impact, as well as continue to be making money, making profit through financing products that they have.
Thank you, Eric. I think this data definitely shows that social finance is not just a feel good instrument, but can be actually a mainstream to the society's various needs in finance. I'm going to now ask Ekaterina the same question, which is, how do we create enabling environments for financial institutions to integrate social considerations into their practices?
Yes, thank you, Wu. I think I have a couple of points to make. Some of them connect already to those mentioned by Eric and to what we said previously as well. I think one thing is, the first thing is to raise awareness of the social issues and the social impacts that financial institutions and broader financial decision makers can have through their decisions, right? When we speak about sustainable finance over the past years, a lot of attention has been put to climate and not necessarily considering any adverse impacts which are being made on society, on communities, and on other areas of sustainability. This has been changing over the past several years already, but what we can see from the practitioner standpoints, in many cases, people are still looking on climate first, also maybe driven by a lot of regulation and disclosure requirements which are falling on them now. So the social angle is not being given sufficient attention yet. So first, raising the awareness within the organization at different levels of organizations, making sure that all the teams are aligned, that the incentives are aligned, and that the strategy is defined in this direction. And secondly, yes, obviously building the capacity, maybe sector-specific risks and opportunities, regional opportunities, and what other practices that financial institutions can adopt. And I think there's a role for international organizations and civil society here to bring these aspects to life for financial sector, as well as to show the way and co-develop such strategies. And second point I would like to make is the importance of an ecosystem approach. Again, financial institutions are driven by data, by information, and it's a way easier for them to find the solutions once they have data, once they have knowledge. And unless data is available, it is more burdensome, more expensive, and easier to skip all the radars. That's why I think on the regulation which is taking place, for instance, in Europe, on corporate disclosure requirements and on integrating social elements within it, within sustainable taxonomies in Europe and Asia and across the world globally, is a very important one, because it gives financial institutions keys to act, actually, once they have access to this information. And maybe last point is the importance of regulation. I guess some of the issues will be easily taken on board by financial institutions, in particular if they see the business case for that, and some of that perhaps needs to be enforced at country or maybe even at international level. I will stop here.
Thank you, Ekaterina. Yes, indeed, a lot of the sustainable finance was, and probably still is, on climate and environment, but it's also good to see that we see more and more the wider term of sustainability finance as well as social finance, and that we need more data and information available, not just among us, but to the very issuers and raters and others to create this enabling environment. Joanna, can I now turn to you for again the same question, which is how do we create enabling environments for financial institutions to integrate social considerations into their practices? Thank you.
Thank you. So I'm discovering that as the first, you don't know exactly how to tackle it, but as the last, most was already said, so it has good and bad things. Just to say, maybe just one thing still through the other questions. So I replied mostly to the risk, but I did put in the chat also how some target setting on specific on financial health and inclusion and on gender that UNEP-FI created. So exactly on how to set KPIs and how to look into these two topics in terms of setting targets within a bank. So just wanted to call attention for that. In terms of the question, I think, I mean, most of the points were made here. There is a part of awareness, and especially I think on the awareness at a higher level. So I think there is more and more awareness from the bottom, let's say, where people do see that there is a need to do things a bit differently. There is a need to include social considerations, but not always that then reach the top. And I think there's really the need also of raising awareness. And I think forums like this one are very important, but other forums and and to see how do we engage with boards, with CEOs to ensure that it is in the agendas and to ensure that they are aware of the importance and of the opportunities, as we mentioned here. So not only seeing the risks, but also seeing what are the opportunities for then the businesses and the financial institutions. So I think that's a very important point that was already mentioned. I think it was spoken here about how climate is one of the reasons, Katja mentioned, for instance, that one of the reasons that climate is also so strongly, of course, one of the reasons is because we need a transition to happen and because climate change, but there is also the regulation and disclosures that comes around it. And I think indeed, and as it was mentioned here, I think we do need policies, we do need regulations that also make that. I think sometimes what happens is in an ecosystem where one wants to do in a different way, but then the others don't do it, that can create imbalances. So having regulations that define the minimum and will support that everyone then is in the same page and that we are all in the same balance. And we do see that in the jurisdictions that are already pushing for more social, we do see changes in the financial institutions that accompanying it. And also to say that not only when that regulation is mandatory, but even when it's just soft laws or just guidance from governments, often do lead for the financial institutions in those countries to then change with their policies and to create different put different importance on the social part. So I do think that is regulatory, both on a more guidance and on a balance between the guidance and the mandatory. Also because what we don't want is that it just becomes a burdensome of tick boxes exercise. We wanted to have a real impact. So I think it's really about a balance also on what needs to be mandatory and what is guidance that supports that environment and doesn't shrink also. And then just a point on data. I do agree that we need data, and that's. But I feel that often is the reason that is given why we are not measuring so many things on social is because of data. And I don't agree that we do not have enough so far. So I do think, and Eric did show some statistics, for instance, from social bonds specifically. So there is a lot of data that already exists and that can be used if financial institutions want to use. There is more that needs to be collected. So I'm not saying that we are where we should be in terms of the existing data, but I don't think it should be used as an excuse on why not to act on social. I think there is already enough to do quite a lot of work. So just wanted also to put a point on that. Thank you.
Great, thank you. Thank you for that very good insight, Joanna. I also think that we need and we are seeing a combination of not just bottom up, but also up down, coming from both government regulations as well as CEOs and decision makers in financial and other private sector institutions, and that's very important for this transition. Now I want to move to some questions that are asked by the audience. I don't think we'll be able to address them all due to constraints of time, but thank you for all of the questions that have been posed. Now I would like to start with a question. What would be some common and today mandatory or even widely accepted social indicators or reporting elements that we see today, and where do you think that might go in the future?
Well, maybe I can take a step in. So I think it really depends on the social factors. When you talk about which KPI or social metrics that we need to report, honestly, if we look at environmental and social indicators, I think social indicators are so much more. There's so much variety of that as compared to environmental, for example. If you look at environmental impact, we know there is probably 6 large group of impacts that you can start measuring: greenhouse gas, land use, water use, pollution, biodiversity, 5 or 6 groups. But for social factors, it's just so many of them. When you talk about affordable housing, you're talking about how many people that have access to it. You talk about healthcare, you talk about access to financing, talk about employment opportunities, for example, broken down by gender, age group, seniority, level of. So it really varies. So I'm not sure if there is one indicator or a few that are mostly reported. One can take a look probably at sustainability reports that companies put out. So if you look at the ISSB or the former GRI indicators, there are quite a number of indicators that companies like to report, but I personally feel sometimes it's maybe because it's easier to collect the data because the HR has a system, things like health and safety metric. People need to do it because it's part of a regulatory requirement. You need to report if there is like close accident, for example, or lost time injuries. So I think those type of data you will find easily, but partly because it's easy to collect the data. But there are other metrics that are very, very important, but difficult to collect. But that doesn't mean we shouldn't start looking into those and collecting them. So I would hesitate to mention a number of indicators that people to start looking into, because that might just be a low-hanging fruit, but might not necessarily be the most material or relevant one for you to report. So what I would encourage you to do is think about what is the material social factors for you and your organization, and then pick out what is the relevant factors for you to start putting in a systems to report or monitor, instead of starting to report things that most people report on.
Great, thank you, Eric. And if we're ready to move on to the next question, the next question is on human rights, and I want to expand the question a bit further. How do we mainstream human rights, like human rights activities like human rights due diligence? Let's say from a financial institution to their client, how do we? Because right now it may be seen as optional, not mandatory, or just something to tick the box. But what are some of the ways we can encourage both the financial institution and the private sector to mainstream human rights, due diligence, and other activities?
Yeah, maybe if I can on that, I think we have seen, particularly in the financial sector, we have seen more and more institutions actually putting out human rights policies and integrating human rights due diligence within their frameworks. And to say that in some jurisdictions it is being discussed to become mandatory. So it is something that I mean, we do have, as I mentioned before, the UNGPs, which were signed by the UN Council. So the UN Principles for Business and Human Rights, which ask from businesses and from financial institutions to have this due diligence process in place. And I think there, in terms of the clients, I think is the leverage. It is not, of course, the financial institutions, their biggest impacts when it comes for labor rights, when it comes from human rights. It's within their portfolio. That's where is the biggest impact. So I think working on the leverage that they have with the clients, on not only requiring but also supporting when needed clients in ensuring that there is the social impacts are taken into account. This does bring to the institution itself, there is a very important also then reputational risks that are covered. And also I think more and more we'll start seeing also litigations related to this. So I think it's something that we really see a change in the last 10 years on how financial institutions are taking on board this due diligence. And I think more and more also we start having the practice. And by having the practice, we also see how can it be done? What are exactly then the responsibilities between the financial institutions and the business, and how to use this leverage in the best way?
Great, thank you, Joanna. Ekaterina, I see you have unmuted. Would you also like to respond?
Yes, I would like to add maybe a layer to what Joanna just said, and also maybe expanding it a bit from human rights, but to different social impacts as well and diligence. So as mentioned, a lot of financial institutions are just at the starting point. They start by putting in place the policies. It is good, it is there. It doesn't mean that it is implemented, right? But I think it is the first signal once the policy is there, once it is approved by the board, that this institution is serious about this issue and is going to take into account. There could be some other process metrics like this, for instance, the number of staff trained on this or that topic within the organization, the number of engagement on human rights, or some other considerations which this organization is doing. And once the policies are in place, perhaps financial institutions already start tracking this kind of progress. Then the next step would be also to try to find the outcomes of this process, some outcomes metrics, which sometimes would be able to which in some cases financial institutions perhaps are able to provide if they're a bit more advanced on this journey. For instance, some kind of evidence of engagements with companies on human rights issues, or perhaps they track human rights incidents in their portfolio and so on. But otherwise, there are also other sources of information, such as NGOs and databases, which can also allow to track the seriousness of implementation of these measures by financial institutions.
Great, thank you, Ekaterina. The next question is, when there are trade-offs between, let's say, environmental and social objectives, how would financial institutions navigate that situation? So it's, I think we can approach this question from an open-minded view. So maybe you can imagine you're advising a potential client or someone that you would like to, that you're already advising, let's say, and yeah, what would you be saying to them about, I guess, competition across more different sustainability objectives? Thank you.
Perhaps I can give it a first shot. So within S&P Global Ratings, we actually have this methodology that we call shades of green. I think you can see it on my background. So what we actually do is we look at a project. Typically, it's an environmental project. And then we provide basically a shading from dark green, medium green, light green, all the way to red to indicate how much environmental impact this project would deliver or avoid. For example, if you have, let's say, a solar power installation that would typically get, a dark shades as opposed to, let's say, a hybrid vehicle investment where probably get a light green shading because hybrid vehicles still rely on fossil fuel to run. Now, where the social impact comes into play, it's very important. We actually have a specific component where we evaluate what is the potential impact that this particular asset has on the society. So take, for example, hydropower. Hydropower, from the environmental perspective, even from the environmental perspective, actually has positive and negatives. In terms of generating the power, of course, it's a green energy because it doesn't emit anything. But in the development of the asset, right, you might need to flood forests. You might need to displace people. And so from our methodology, you may start off with a dark green color because we look at how the asset itself actually generates clean energy. But then we start downgrading the shades that this asset will have because we start to look at how it might displace villagers because you are starting to build a dam. You are also destroying biodiversity and all other things. And so we have, within our organization, we have started to think about these impacts as a combined effect, not just environmental and social separately. And we find it increasingly important for us to take those two things into account, which is why if you see all our reports right now, we would take into account both elements in our credit rating. Again, we'll look at environmental and social, put it all together. In our second party opinion, even if it's a green project, even if it's a green bond, if there is any social risk related to that green project, we will highlight it, and vice versa. If it's a social bond, if this social project has any environmental related risk, we will also highlight it. Now, this is something that I think it's quite unique in terms of approach in the market right now, but that is our view. And I think that is very much in line with what one of the audience has asked here. It's just, I think the only challenge right now is how can we distinguish or say that impact from environment is better or lower than impact from society. And that is the part that the quantification bit is probably the next level that we are thinking about. But at the moment, qualitatively, we are already incorporating that into our analysis.
Great, thank you, Eric. Joanna? Yes, go
I know
ahead.
that we're finishing, but just a small point to add to Eric. So I completely agree, and I think we need to have a holistic view of the impacts, and then and that's how we can make decisions. But also just to say that we often speak about the trade-offs, but there's also the opportunities that come with it. So we can actually improve projects that are green by including the social aspects to it, or improve social bonds by including the green part. So we can actually tackle both. So that's also another way to look at it. It's not always about trade-offs, but often it's also about opportunities.
Great,
And
thank
maybe,
you.
and maybe
Go ahead.
adding a last layer to that. So yes, I also very much like this approach of combining the two together, right? And I just wanted to highlight, yes, indeed, there's this perception of contradiction between environmental and social, but perhaps we also need to bring a perspective in case that there's lack of social cohesion. The environmental project will not take place if people who are being displaced start protesting. This hydroelectric station will never be realized. If there are no people who can run greener business, it will not be able to be executed. That is why it's very important to address the two at the same time.
Great, thank you, Ekaterina, and everyone for your insightful responses. Unfortunately, we have run out of time and we do need to close now, but thank you to everybody, and thank you as we draw this insightful close. I do want to express my gratitude to our panelists as well as our very active participants today for joining us. Again, we invite our participants to complete our short survey after the webinar. Your feedback will help us deliver more valuable insights in our future events. You may find the full recording of the webinar on our website within 24 hours of the closing of this webinar. You can also stay in the loop about future GGKP webinars by signing up for our newsletter at ggkp.org/subscribe. Also, please share your insights and discussions around sustainable finance and other topics on sustainable development on our thegreenforum.org website as well. Thank you, everyone, once again for being part of this webinar, and we look forward to seeing you in future events. Stay safe and have a great rest of your day. Thank you, everyone.
Thank you. Bye-bye.